Thousands of Australians are about to pay tens of thousands of dollars in a brand new tax that 3 years ago did not even exist, and most of them still do not understand how it works. Some will owe $15,000 a year, others will owe closer to $90,000, and here is the strange part. It is not a tax on how much money they have. It is a tax on how well that money performs inside superannuation. In this video, who pays, how much it costs, how Division 296 is calculated, and the 4 strategies people with large super balances are already using to reduce the damage. One only works once. Another is completely irreversible, and most people do not know either of them exists. Let us start with the number that matters most. Someone with $12.9 million in superannuation. Under the new rules, their additional tax bill on top of everything the fund already pays is around $88,000 in one single year. Run that forward 10 years, and that is nearly $900,000 taken straight out of retirement. And this is not a proposal sitting in a drawer somewhere. Division 296 became law on the 13th of March 2026 and takes effect from the 1st of July. The first assessments come after the 30th of June 2027. The clock is already running. Think about that for a second. $88,000 a year, and most people affected still cannot explain where that number actually comes from. So let us break it down piece by piece. Division 296 is not a wealth tax. It is not a tax on your balance. It is an additional tax on the earnings your super generates: dividends, interest, rent, and realized capital gains, but only the portion of those earnings tied to the amount above $3 million. That is every super account you hold across every fund type: self-managed super, industry funds, retail funds, accumulation, pension, all added together into one number. But here is what makes it different from every other super tax you have dealt with. It is a personal tax, assessed against you, the individual, not your super fund, not your employer. Your fund does not pay it. You pay it yourself, and that completely changes how you plan for it. If you have a large super balance or a self-managed fund, I would genuinely love to know in the comments, did you see this coming? The government estimates it affects around 80 to 90,000 Australians, roughly 1 in 200 people with super, about 0.5%. And it projects the tax will raise $2.3 billion in its first full year. That is a lot of revenue from a very small number of people. And here is a detail that almost no one talks about. In the first year only, Division 296 is based solely on your balance at the 30th of June 2027, not your opening balance, just your closing balance. From 2027 to 28 onward, the ATO switches to the higher of your opening or closing balance. That first-year rule creates a narrow window, and when we get to the strategies, it becomes the single most important date on the calendar. Now the 2 tiers. Tier 1 balances between $3 million and $10 million. Your fund already pays 15% on earnings. Division 296 adds another 15% on top. The effective rate on those earnings, 30%. Tier 2, everything above $10 million, an additional 25%. The effective rate on that slice, 40%. Think back to that $88,000 bill from the opening. It is starting to make sense now, but here is where the original proposal went badly wrong. Back in 2023, the government proposed taxing unrealized gains, paper profits on property or shares you had never sold. A commercial building sitting inside your SMSF goes up $500,000 on paper? Under the original draft, you would owe tax on that gain without having sold a thing. Industry fought that proposal hard, and the government backed down. The final law only taxes what you actually receive, realized earnings. If an asset in your self-managed super fund doubles in value on paper, you owe nothing under Division 296 until the day you sell. That single change matters enormously for anyone holding property or long-term shares inside super. Now let us put real numbers to it. Scenario 1, $5 million in super, 5% realized return. That gives you $250,000 in earnings. 40% of that sits above the $3 million line. $100,000 attracts the extra 15%. That is $15,000 in additional tax for the year. Meaningful but manageable for most people at that level. Now compare that to the case we opened with: $12.9 million, $645,000 in earnings. 54% falls in the 3 to 10 million slice. 22% sits above 10 million. 52,000 on Tier 1, 36,000 on Tier 2, $88,000 in a single year. Now you know exactly where every dollar of that opening number comes from. Drop a comment. What do you think should be the threshold? 3 million? 5? Higher? Or should there be no additional tax at all? Now the part everyone with a large balance is waiting for 4 strategies, and each one comes with a catch. The first only works once. Withdraw enough before the 30th of June, 2027 to bring your total balance below 3 million. In year 1, Division 296 uses only your closing balance, so pulling out enough puts you below the threshold entirely. But from 2027 to 28, the ATO switches to the higher of opening or closing balance. The window shuts permanently after 12 months. And you need to meet a condition of release to access the money, which typically means being at least 60 years old and retired. The second only works if you have a partner. The threshold is per individual, not per household. That means a couple can hold $6 million across 2 accounts, and neither one triggers Division 296. Contribution splitting, spouse contributions, and recontribution strategies all push balance from the higher member to the lower. With the non-concessional cap now sitting at $130,000 per year, meaningful amounts can move over time. The third is irreversible, and possibly the highest stakes decision on this entire list. The CGT cost-base reset, available only to self-managed super funds. You reset every asset to its market value at the 30th of June, 2026, for Division 296 purposes only. Decades of pre-existing capital growth get locked away permanently, so they never get captured in future calculations. But it covers all assets, or none you cannot pick and choose. And the deadline is the due date for your 2026 to 27 SMSF tax return. Miss it, and it is gone forever. And the fourth buys time, but not a solution. For members of industry and retail funds, a graduated transitional relief applies. 80% of capital gains are excluded from Division 296 in year 1, dropping by 20% each year until full exposure hits by 2029 to 30. Now that you understand how Division 296 works, here is where it sits. Total superannuation in Australia, $4.4 trillion. Average balance across 17 million accounts, 183,000. Median for those near retirement, around 250,000. 75 to 80% of Australians retire with less than 500,000. Division 296 targets, a fraction of a fraction, but the 2.3 billion. It shows just how concentrated super wealth really is in this country. Division 296 does not eliminate the advantages of super, but it completely changes the rules for those at the top. The withdrawal window, the spousal split, the cost-based reset, those are not loopholes. They are the mechanics the legislation was designed around. The gap between knowing them and not knowing them is tens of thousands of dollars every single year. Super was always the best tax shelter in Australia. It still is. But the rules just changed, and knowing how they changed is not optional anymore. If this helped, subscribe and hit notifications. More like this is coming. Thanks for watching.